if we go back 3, 4, 5 weeks ago, everybody was talking about government shutdown, Middle East, oil is going to go to 150, Russia, Ukraine, China, blah, blah, blah. There's a million things. Everybody was all scared like 3, 4 weeks ago. All those things are still transpiring. All those things are still going on. And just no one talks about it now, right? You see a stock like Enphase come back. It's not because their numbers have come back. Let's be very clear about that. And their numbers could deteriorate worse over this next few quarters. There's just some momentum in the market. So, in regards to an Enphase, you can't get too confident in this move here recently. That's the best way I could put it. You can't get too confident. And we are definitely in a very different time, right now than we were back then, right? We've had, Robinhood amount of users they've lost in the past 2 years or so is around 10 million, if I recall. 10 million. So, howdy there, folks. Hello, chat. Hello, hello, hello. Hope everybody's doing phenomenal out there, as always. Got an interesting bunch of stuff to speak about here today, folks. Oh, yeah, we got a bunch to get into in this one. Woo-wee! So, first off, it's not like the market's great today, right? Russell's up 0.3%. S&P 500's up 0.25%. NASDAQ's up 0.2%. Dow's up 191 points. It's an okay day. But damn, if you're on the right stocks today, folks, it's a freaking great day, right? You're on Target today, which has been an easy money buy for the last few months now at this point in time. Just easy money. Look at that, baby. 17.7% here today. Elf on a Shelf continues to roll. That one's up nearly 7 percentage points here today. Foot Locker's pulling up 5%. Nordstrom 5%. Revolve about 5%. Fubo's nearly a 4% mover now, over $3 a share. Shopify 3.5%. Pfizer 3.5%. PayPal's having a nice move, 2.6% here today. Tesla also up 2.4%. If you're in the right type of stocks, you're flipping flapjacks here today. You're flipping those flapjacks. If you're not, no, it's not so good, right? Now, let's go ahead and start going through this. So, safety stocks watch list here today. A little bit of a mixed bag other than Target. Target's the one stock that's just way outperforming here today, right? You look at Kellogg, Pepsi, General Mills, Monster, Procter & Gamble, Kellanova, Campbell's Soup, Kraft Heinz, Microsoft, Mr. Softy, all down today. Coca-Cola is close to going down. If we pull up my potential buys list, let's come back to that. 6 stocks I'm hedged against. So obviously Dow being up good quite a bit today is bad for my S-Dow. Toll Brothers is down, Chipotle's down, so that's good for those hedges. Apple's up, and Tesla's up, so that's bad for those hedges, but it doesn't matter as long as Tesla's up. But it's a lot of profits there, right? And Polaris is up, so that's bad for that hedge. Oh, let's freaking go, baby. Let's freaking go. Let's freaking go, baby. That's what I'm talking about. Look at commodities. Oh my gosh. Can we have our cake and can we eat it too? Oh man. Woo-wee. Look at that. Look at that. WTI down 2% here today. Oh my gosh, does it get better than this? GSG down today. Does it get freaking better than this? Oh my gosh. Oh man. This is 2023, right? 2022, it seemed like everything that could go bad went bad. And it just got worse and worse and worse. And it's like, can we ever get a break? And it just seemed like 2022 never provided that break. And 2023 is just such an opposite year where it's just like, damn, man, everything's just going so freaking perfect. It's just thing after thing after thing. Man, it's just one of those years. I think 2024 will probably be one of those mixed bag years. We'll have some stuff go right, we'll have some stuff go wrong, but it'll be a bit of a mixed bag. Whereas I think 22 and 23 have just been freakish years, where 22 is just everything couldn't have gone worse, and 23 is just everything couldn't have really gone better for the most part. Housing stocks. Well, look at the move on Redfin. Redfin was up 18% yesterday. It's up another almost 13 percentage points here today. Woo! What a move. RH, damn you. Damn you, RH. Come back to reality. Come back to reality, RH. I still want to see you under 200, baby. We'll hope. We can hope. A man can hope, right? Enphase, 2% up move here today. That one's back up to $93. That one hit a low of, 77, 76 a couple weeks ago. So definitely a nice comeback here in Enphase. Now, does it last? I think that's a whole other debate, right? You see a stock like Enphase come back. It's not because our numbers have come back. Let's be very clear about that. And their numbers could deteriorate worse over this next few quarters. There's just some momentum in the market. So, in regards to an end phase, you can't get too confident in this move here recently. That's the best way I could put it. You can't get too confident. When the numbers change for the positive, then you can start getting really confident. But for right now, still a little early there. Whirlpool, I want this baby to fall back down there. And, I don't have a lot of faith in these housing-related plays. I think it's just short-term momentum there. We'll see. Okay, so let's see. The professor, he's still on?
For a rally in bonds at the short end.
Well, I truly believe that investors need to have a 2-year outlook on rates, not a 1-year outlook. It is very uncertain how the economy is going to play out here, where interest rates are going to be over the shorter term. But I think it's fair to say over the next 24 months, you could argue that interest rates are going to be lower. The Fed will have cut rates to some degree. We don't know when they're going to start or how aggressively they're going to cut.
I completely disagree with him. 100 flipping flapjacking percent. I think it's way easier to see where rates are going to be over the next year, over the next 12 months, and make predictions around that. Making predictions 2 years out? Hell no. What if the economy stays in a really good place for the next couple of years? What if we get an increase in inflation at the very end of 24 going into 25? What does the Fed have to do in that sort of situation where the economy starts heating back up again in a major way in 24 and we see some sort of spike? What happens if the economy gets devastated in 2024 at some point in time? I think it's way easier to forecast the next 12 months than 24 months or 36 months when it comes to rates. So I just 100% disagree with him.
In terms of increased duration supply hitting the market at a time where demand for Treasury debt is moving from price-insensitive buyers to price-sensitive one. So I wouldn't rule out a potential another leg higher in the back end of the curve. And so that's why I think 1 to 3 years the sweet spot. Once the Fed kind of puts the stake in the ground and says that they're done, that's when I want to start to leg back into intermediate and longer duration fixed income.
All right, for the record, Lauren was shaking her head yes in agreement as you were talking before we showed the boxes of everybody. Professor, I give you the last word. Leave us with a thought here as we have the Dow up better than 200 points. We're going to make a little run here, it looks like, as we hit this final stretch.
Yeah. Well, look, I see very few excesses in the market. It isn't like 2 years ago with the meme stocks. It isn't like the NFTs. It isn't like the craziness of the pandemic stocks.
Truth.
And, the SPACs and all that. I see very little, and that's why I think that this is a very sound rally that has legs.
Ooh.
We will make that, in fact, the last word. Professor, thank you so much. Everybody, have a good Thanksgiving. If I don't see you guys before, Jordan, thank you. And Lauren, of course, thanks for being here with us again as well. We are watching Disney
the
shares
professor
today,
will be back
too,
on before
moving
Thanksgiving. That means on every
another
day.
activist investor in that name. Julia
What?
Borston has the details
Another
for us.
activist
Julia?
in Disney?
Scott, Disney shares gaining almost 3.5% today on news that Value Act has taken a significant stake in Disney, and the media giant is now one of its largest positions. According to reporting by 13D Monitor's Ken Squire.
Anybody own Disney in the chat, by the way? If you own Disney, let me know in the chat.
WGA and SAG strikes. And key to Value Act's interest in Disney is a thesis that the company's theme parks and consumer products businesses alone are worth a stock in the low 80s a share. Now, notably, Value Act is reportedly friendly in contrast to Nelson Peltz's move at the beginning of this year, with another move by Peltz, now joined by former Marvel Entertainment Chairman Ike Perlmutter, potentially in the works. Now, looking back at the nearly 12 months since CEO Bob Iger retook the helm, shares are up just about 3%. We're pretty much flat before today's news. And worth noting that Value Act is no stranger to media stocks. It's currently an active investor in the New York Times Co., Spotify, as well as Fox.
Dutch Bros back up to 28.
Good to know. Julia, thank you so much.
Dutch
That's
Bros.
Julia Borston. That brings us to our question of the day. Does another activist investor in Disney make you more optimistic about that stock now? You can head to @CNBC Closing Bell on X to vote.
I wouldn't
share
feel
the
more
results a little
optimistic,
later on
no.
in the hour. In fact, we're just getting started here, though. Up next, Microsoft is getting into the AI hardware arena after announcing 2 new AI chips.
Wow.
We have a shareholder standing by with his first reaction, plus his top tech plays with that sector.
Wow,
Mr.
Mr.
We're live
Softy.
in the New York Stock Exchange.
Mr. Softy just wants to get in everything. Holy smokers, that's no dang jokers. So I want to speak about something here for a moment. The professor was talking about, essentially, it's so different than 2 years ago, right? 2 years ago, the meme stocks, the SPACs, all that crap, NFTs, crypto to the moon, everything that was going on, right? And we are definitely in a very different time, right now than we were back then, right? We've had, Robinhood amount of users they've lost in the past 2 years or so is around 10 million, if I recall. 10 million. So there's no real FOMO in the market at this point in time. There is no, and I'm just speaking about the retail kind of side, right? A lot of retail left the market and never came back and just got destroyed on either the SPACs or the crypto companies going under or a bunch of other crazy strategies, or then the ones that left the market but from the long side and then entered the short side going into this year to get absolutely obliterated. No way faster can you lose your portfolio than a situation that obviously transpired this year where people were buying heavy puts, and then next thing you know, just look at what the stocks that they were all buying puts on did. They went absolutely to the moon, right? So, like I always told you guys, like 2021 really reminded me of kind of like 1999 in the tech bubble, right? That blow off top, just craziness. Like everybody wants to take max risk, right? And then my opinion of 2022, 2023 is kind of the come down from the tech bubble, which tech bubble started popping 2000, 2001, 2002 was kind of like the flush of the tech bubble, right? And just got rid of all that speculation and just made a lot of people either leave the market or just really focus on like quality and good income statements, balance sheets, company business models, and things like that. And that's exactly what we've kind of seen play out now at this point in time, right? Where everybody's a little risk adverse. If anybody is taking any sort of bigger risk out there, they're taking it with small positions, right? And small position sizing, or doing it through smaller positions in a call option or something like that, rather than before it was like all in, this stock or this stock or this crypto or this NFT or, whatever, that was just the time period we were in 2021. And it's so dramatically different. So dramatically different. I know a lot of people that don't even want to buy anything investment related right now. They don't want any crypto. They don't want any stocks. They don't want anything, right? And they've really been in that place for the last like 12 months or so. What people need to see to get back in the market in terms of retail side for the most part is stability for at least a year or a few years, where the market kind of trends up, where they have confidence in the markets, in confidence in what's going on, and then they'll enter back in the market. And when they enter back in the market, then we'll tank again. It's the same story as always, right? But so yeah, this whole time period we've been going through, folks, it really, really reminds me of what happened in the tech bubble. It really does. The popping of the speculation. A lot of companies went under in the tech bubble, and the ones that made it through to the other side ended up growing to become giant businesses and giant companies, right? There was a lot of stocks that got hit in the tech bubble between 60 and 95%, right? And there's a lot of stocks that went down 100% and went completely belly up. And I look out there and I'm like, damn, there's so many stocks that went down 60 to 95% and a lot that went BK, right? And now it looks to me like the ones that made it through to the other side, those companies could have some very bright futures in front of themselves. They made it through the tough, right? And so anyways, I think Jeremy Siegel had a pretty good point in regards to that. That's what I'll say about that. There, okay? Hold your horses for a moment.
He's fully committed to the AI for the enterprise. I think the announcement of the AI chip, that was rumored, and they actually officially announced it today. I think it's a good move for the company, to be frank. I think a lot of people started to think back during the PC arms race where Intel was the only chip in town, and pretty much...
Well, this is interesting about Microsoft on the chip side, but do we really think Microsoft's going to have a chip that can compete with NVIDIA? I don't know. I'm not convinced of that. If they do, damn, that's huge for Microsoft, but I'm not convinced of that at all. They can have something on par with the H200. I'm not so convinced of that. Now, what's interesting, to go back to what we were talking about before in regards to kind of the tech bubble and the most recent bubble we had, we kind of think about it as like 2 years ago, like a 2021 thing. But I'll be honest with you guys, the most extreme part of the bubble, the most recent bubble we had, was not actually 2 years ago. Because a lot of people think about 2 years ago, that was when the NASDAQ topped. That was actually not when the bubble activity popped, in my opinion. That was where those big tech stocks kind of peaked out and whatnot at that particular time. But I do not believe that's when the bubble actually started to pop. I believe when the bubble started to pop, it was in this time period, really, which to me, peak bubble really felt like the spring and summer of 2021, which was about 2.5 years ago. Everybody looks at this time when the indexes peaked right at the very beginning of November of 2021, 2 years ago, and they think that's when the bubble actually started to pop. I actually think it was right in here. And if you look back to a lot of the SPACs, those speculative companies, almost all of them peaked in the springtime or summertime of 2021. So it was actually about 2.5 years ago. It was about 30 months ago, 32 months ago, that in my personal opinion, the real bubble started to pop. And you saw the riskiest stuff start to get hit. A lot of the altcoins and things like that started to get hit, and peaked in either the spring or the summer of 2021. And ultimately, you saw, kind of the downfall of a lot of things start to fall apart at the very end of 2021. And then obviously we know what happened in 2022 and 2023, right? But yeah, Bitcoin peaked right there in November. That's when people think for the feeling, the vibe of max FOMO craziness, it was honestly really right in here. That first quarter, second quarter of 2021, that was just nuts. Absolutely nuts in terms of just, everybody losing their minds. Anybody think Microsoft's really going to create chips that can compete with NVIDIA? That seems wild.
Chips
So TJX owns, if I recall, a few different brands. Let's see here. So I just want to look at their raw numbers. Oh, actually, hold on. So Marmax was up 7% comp store sales. Wow, that's a strong damn number. Is that accurate? Wow, Home Goods was up 9%. And then TJX, Canada 3%, international 1%. Really? I'm surprised. I'm really surprised. What? Really? Store locations. I'm going to just see their income statement here. So net sales, wow, I'm surprised. I'll be honest with you guys. I was not expecting this. Net sales for the company, $13.2 billion versus $12.1 billion in the same quarter last year. Cost of sales, $9.1 billion versus $8.6 billion. Impressive. Ooh, SG&A was I don't know, they didn't watch their SG&A very well, I will say that. Almost $2.6 billion versus around $2.2 billion in the same quarter last year. But still, their income before taxes was up substantially, almost $1.6 billion versus $1.35 billion in the same quarter last year. Net income, $1.19 billion versus a little over $1 billion in the same quarter last year. And EPS, diluted EPS, 103 versus 91 cents. That's a win. That's a win in this environment. I'm impressed. I'm thoroughly impressed. Good for TJX. Damn, TJX. Look at you. You go, girl. Wow. Okay. TJ freaking X. Really? Did we find an opportunity here? I'm impressed by that income statement and balance sheet. And they're down today? No. Forward P at 24? Ooh, that's a bit high for a retailer. That's a bit high. Earnings estimates. Damn you, TJX. I thought we might have one here. After that balance sheet, that income statement, got me intrigued, but it's trading a little rich for a retailer. So, but you can say it's quality. I mean, for them to put up their numbers in this sort of environment, that's quality, right? That's what a quality company does. Even in a tough environment, they put up a very respectable, good number. Then again, you think about it, if you're in a tougher consumer environment, a lot of people do want deals. And when you do think of deals on clothing, you do think of Marshalls. But the Homes Good number kind of shocked me, considering how bad the real estate market is right now and how few people are really moving around right now. I'm very surprised and almost shocked at how strong the Home Good numbers were. Really, really surprised. The problem is that forward P of 22, right? 22 times next year's numbers. Oh, that's a tough number to pay for a retailer. Because at the end of the day, this is a retailer. And anything over 20 is tough to pay for a retailer. Anything even over 15 sometimes is not the most attractive. But you look at this company's financials and it's hard to say this is anything but extreme quality. I mean, extreme quality, right? So we call this the noob retail trader investor life cycle, what I got up for you guys here, okay? And basically how this works, and it works pretty flawlessly for the past 100 years or so. So maybe someday it doesn't work, but it usually works pretty flawlessly. So here's what happens, okay? Wall Street causes a lot of volatility in the market. And, you know, stocks start going down, market starts getting crazy out of nowhere, right? And then we look for reasons to pin it on. So it's this or it's that or whatever, right? Oh, it's the Middle East, this happened. Oh, Russia, Ukraine. Oh, inflation. Oh, the Fed. Oh, whatever, okay? Something it gets blamed on. There's a million different things. It's always going to be a million different things. So then everybody essentially blames it on something. Everybody starts talking about that. The media starts talking about it. Everybody starts talking about it, right? Retail, consumes all this. They see their stocks going down. They get scared. All this volatility, all this scary stuff, and retail ends up selling their stocks, right? And, it depends on how weak the hands are, essentially, is what would make them sell. And I know people that sold, obviously, in the Rona crash, which was a very, very scary situation. So that made a lot of people sell. But there can sometimes be things that are much less severe than that makes retail sell. Sometimes it needs to be something dramatic that tells them, oh, shit, I got to sell. Sometimes it's got to be something, a little bit stronger to get people to sell, right? So then they end up selling or they end up shorting stocks. Then right after that, Wall Street buys. And I was actually speaking about last month, in October, retail sold the heaviest they sold in years. They sold $16 billion last month, right? And then look what happens as soon as we, get into this month. I mean, the market just goes beast mode, and stocks start flying up, right? So Wall Street buys right after retail sells all the stocks for insanely cheap, right? Then suddenly no one freaking talks about it anymore, right? And this was the point I was illustrating yesterday, where it's like, if we go back 3, 4, 5 weeks ago, everybody was talking about government shutdown, Middle East, oil's going to go to 150, Russia, Ukraine, China, blah, blah, blah. There's a million things. Everybody was all scared like 3, 4 weeks ago. All those things are still transpiring. All those things are still going on. And just no one talks about it now, right? It's like, what happened to all those things? Like, what happened? Did it all end? No. It's still all going on. But it goes away, right? Then things are calm for a while, whether it be months or whether it be years. And then retail ends up getting back in the market. And then shortly after that, next thing you know, Wall Street causes the next major leg of volatility of stocks crashing, going down, blah, blah, blah. And same cycle repeats again and again and again. And it's really been like this for the past 100 years. And it'll probably be like this for the next 100 years. I don't really see it probably being any different anytime soon. And the worst part is I think a lot of people already know this, but they still fall for it, which is interesting. Like, I know smart people that fall for this still, and something bad happens and they sell and they do this and they do that and all these questionable decisions, even though they know they shouldn't be, but they're the power of their gut is too strong, and they know they shouldn't really be selling. They know that's probably a bad decision. And they know if things are rough or things are bad, they should probably be buying. But instead of buying, they don't buy, and then they sell. And then right after they get done selling, next thing you know, Wall Street comes in and scoops it up. So, and I remember in March of 2020, even myself personally, I even considered like, man, maybe I should sell everything. This was probably the first week or second week of March of 2020. I was even considering like, man, maybe I should just dump everything. This is bad. Like, what if they actually keep the economy closed for 3 years? Like all these companies going to go bankrupt. Like we're going to have a situation worse than the Great Depression. And I even considered it, right? I didn't do it, thank goodness. But, there's levels of severity. And obviously what happened in 2022 with that level of volatility, that got a lot of people flushed out, right? There's a reason Robinhood's users went from, what was it, Robinhood amount of users over time. So I don't even think this is the most updated number here. I think it's even lower than this. But basically, Robinhood went from 22.5 million users in 2021 to now they have around 10 million users. So their users dropped over 50%, right? And that's because over that time span, like retail just left the market. They're like, I'm out of here. This is the stock market's a scam. This sucks. Like blah blah blah. And so that's what happens. It's what happens, folks. And I think it's important everybody understands the cycle. Because then if you understand the cycle, I think there's at least a better probability you don't fall into the cycle. But with that being said, there's still going to be people that fall into this cycle. There might even be a few of you guys, the 194 people watching this right now, there might even be a few of you guys that might fall into that cycle in the next big wave of volatility. And you say, hell with this, and you sell. And so my hope is, no one falls into that trap, and you know that this is all a big game of who can hold through the bad times and who's buying during the bad times. That's what it's all a big game of, right? And I showed a chart of the NASDAQ since I've been in the market, and I mean, my gosh, the amount of times during just my investing lifetime that it's been like this to worry about, that to worry about, this problem, that problem, serious stuff. Like we had trade wars, we had tariffs, we had thoughts about nuclear war with North Korea. I remember when that was a whole thing. That was a worry. That was a serious worry at a time, like literally nuclear war with North Korea. We had worries about China, Taiwan. We had Rona. I mean, we had Ebola scare. We had a bunch of other disease type scares, terrorist type stuff, right? That whole presidential related thing where was Trump going to leave office or was he not going to leave office? Was there going to be a peaceful transition of power? Remember that worry? Like that was a worry, right? That was something we never really had to ever deal with in the history of the United States was the worry about like, is there going to be a peaceful transition of power? You run through everything we've dealt with just in my investing lifetime the past 15 years. And yet every single time, what was it? It was a buy the dip opportunity. Every single freaking time. And you just got to be thankful for whatever the BS is that's going on out there at that particular time. And it's always a different form or fashion. It's always a different, this we need to be scared about. This we need to be scared about. It's always something else. It's always something. And when you get those somethings, just understand you got to take advantage, right? But, I'm sure there was people that sold out, when Russia invaded Ukraine. I'm sure there's a lot of people that were like, the hell with this. I'm not staying in this market. It's going to be World War III. Oh my gosh. And so anyways, it is what it is. But just understand the cycle. If you understand the cycle, there's a higher probability you won't fall into the cycle, right? This is like, I call it like the DARE program. You guys remember the DARE program as a kid? Was it drug awareness or whatever, right? And if drugs are dangerous, you're less likely to maybe take them or whatever. This is like DARE, okay? If you know the cycle, hopefully you can avoid the cycle because, it's no fun. It's no fun, folks. All right, let me jump back into the chat here.
Okay. Hold tight. Cisco earnings are out. Christina Partsinevelos has those numbers. Christina?
A slight Q1 beat for networking equipment maker Cisco, but guidance is very light. That's why the stock is plunging right now, 13%. EPS 8 cents higher than expected on revenues of $14.6 billion, a slight beat. Gross margins also a beat, but it's the guidance that really fell short of expectations. They're guiding Q2 revenues in a range of $12.6 to $12.8 billion, much lower than the $14 billion estimates. It's a similar problem with Q2 earnings as well. Management in the press release said they saw a slowdown of new product orders in the first quarter of fiscal 2024. Customers working through their inventory with 1 to 2 quarters of shipped product orders still waiting to be implemented by its customers. So that backlog continues. On the full year outlook, the midpoint of the range is over $3 billion
just saw
less than
Fubo on
street
the
estimates.
ticker symbol.
Full year
Awesome.
EPS also light. CFO Scott Herron says, quote, "We expect to see product order growth rates accelerate in the second half of the year."
Let's go.
Shares
It's good. Push it
plunging
out.
down
Push it out.
13%, almost 14. Oh,
Push it
13.
Oh, yeah. Christina Partsinevelos, thank you. Charlie, is this one we need to worry about? There was a time when Cisco was a bellwether for the whole tech sector because of the kind of equipment that people were buying for their data centers. Not as much anymore, but that idea of a demand slowdown for some of this hardware, or maybe there's just a unique stockpiling, inventory issue for networking equipment writ large.
Not a big beat for Palo Alto
How do we
top
take this? I know you
line.
tend to look at value stocks, maybe not a name like Cisco, but is this a warning of any sort, or maybe just an individual case?
Good job, guys. Good job. I was just looking at this Mohawk Industries. This is actually an interesting company. They make like carpet, tile, laminate, wood. They seem like a huge player in the market overall. They own a ton of different brands. Obviously, an industry that's in a bad place right now because of real estate being so weak and housing being so weak. But taking a peek at their numbers here, net sales, this is their latest quarter, $2.7 billion they did. Obviously, those numbers are down year over year. Adjusted EBITDA, $389 million. Adjusted operating income, adjusted EPS. I want to see the straight up numbers is what I would love to see in regards to this. I want to see that, and I want to see their balance sheet as well, because this is one of those companies that could be debt loaded. So it looks like they have, $529 million in debt come due June of 2027, $600 million in 2028, $500 million 2030. Okay. Let's take a look at Microsoft's valuation here and see where we're looking at, roughly. And we can run a little more bullish scenario, a little more bearish scenario. So, Microsoft, so their fiscal year ends at a weird time. It ends in June. So they're trading about 33 times this year's expected numbers. So we can say, let's say there's a scenario we're a little more bullish on Mr. Softy, then maybe they are at about a 30 forward P. Let's say we think, Mr. Softy's going to do more in EPS than what analysts have on average. So, 30 is still kind of up there. And then looking at next year's numbers, you're trading about, 28 times. So you can say, what if they come in better there and they do like $14 something? Okay, so maybe they're at a 25 times. So the stock's certainly not cheap. Certainly not cheap. I would say it's probably fairly valued or slightly overvalued. That's the way I would put it with Mr. Softy. Fairly valued or maybe slightly overvalued. But I feel like it's kind of in the range it should be. I do not think you're getting a steal deal on Microsoft by any stretch of the imagination. But I also wouldn't say you're getting ripped off. Microsoft's trading at, far exceeding numbers like that. Let's say it's trading at 45 times this year's numbers. I feel very different, right? But at 33, for this quality, the growth they have, the products they have, the stability they have, 33 times this year's number, I can definitely understand that. Now, it's going to be interesting to see where futures open because, Cisco being down the way it is, Palo Alto being down the way it is, that's not going to be good for the Qs, really. And so I do wonder if that's going to put some real pressure on the Qs. That's something I'm kind of thinking about here. By the way, back to this Mohawk Industries. So $2.76 billion in net sales, 2.9. Gross profit came in at $692 million versus $713 in the same quarter last year. Operating loss was massive, but it's okay. It's okay. It's okay. I'm going to add them to my housing stocks watch list right now. Where's my housing stocks watch list? Let's see. Housing stocks. And what was it? MHK, was it? The ticker? Mohawk. There it is. I'm going to add them there. There we go. Got them on my housing stocks. That'll be an interesting one. I might do some more digging on that guy there. You know, I just think a lot of the money, the biggest money next year will be made in different areas than they were made this year, right? Where this year you really look and it was a lot of the biggest money to be made was really in the most obvious big tech type stocks. And I think next year is going to be different. That doesn't mean I expect all the big tech stocks to do bad necessarily. I mean, there's still a potential that stocks like Meta and Amazon and a few others could actually go up next year, right? Maybe even Tesla. If, let's say, Tesla's margins came in better than anybody anticipated on Cybertruck or something like that, maybe Tesla has a good year. You know, Palantir, if they come out and just knock the ball out of the ballpark next year, plus S&P 500 inclusion on top of that, that would be extremely bullish. So it's not like I'm expecting those stocks to necessarily do bad. It's just a lot of the easiest apples from those trees have been picked now because the performance has been so insane this year. And so I wouldn't be surprised if a lot of the big techs are flattish next year, maybe slight gains, something like that, or slight losses. On the flip side, I think there's a lot of other stocks that set up insanely well. A lot of the small cap stocks, a lot of the dividend stocks that have been beaten down this year, a lot of the fintech stocks, to be honest. I think there's a lot of stocks that set up really freaking well for next year. And so I think there's going to be a lot of money to be made next year as well. Like I said, I just think it's going to be, the big money's going to be made in different areas than were made this year, right? And even a day like today, a trading day like today, the big money was to be made out there. But it was in different stocks, right? You know, Amazon, Meta were down today. But then you look out there and you see some of these other stocks, you see 4, 5, 6% movers all over the place on a day like today, right? You see a Target that's a beaten down dog up 17%. You see an Elf up 6.5%, Foot Locker 5.8%, Nordstrom 5.7%, Revolve 4%, Shopify big day, right? Fubo another big day, 3%. PayPal a beaten down dog there, 2.7%. So it's just there's different opportunities going forward into 2024 than there was this year, right? And that's the best way I can put it. So, but anyways, guys, going to get to work on a main channel video now at this point in time. I appreciate everybody joining me as always. I'll be here for you guys tomorrow. But anyways, guys, much love as always. Thanks for joining me. Thanks for being here. Shout out to the chat. Appreciate you guys. And see you tomorrow or on the main channel tonight if you watch that. Much love, folks. Peace.